Hi everyone, my name is Do Kwan and I am a co-founder and CEO at Terraform Labs. So at Terra, most of the work that we do is focused around usership of cryptocurrencies. So we are one of the many organizations across the world that is looking to get cryptocurrencies widely adopted. Today, I'm going to be specifically focusing on what new features need to be built into cryptocurrency, like in order to get it to be more widely adopted across the world. I think everyone can agree that whereas with every passing year, adoption for crypto is getting better, mass adoption isn't here yet. So depending on who you're asking, the number of active Bitcoin addresses ranges from anywhere between 7 to 40 million, whereas the number of active commercial banking accounts is about 5 billion or somewhere northwards of that. So given the 1000x difference, I think we can all agree that there's definitely room for growth here. And now let's start to dig into the reasons why mass adoption hasn't happened yet. All types of monies, including cryptocurrencies, is a type of product. And if you view money as a product, it is actually quite simple with just two features. Number one, holding. So you can choose to hold your money in a bank account, or you can stake it in the case of staking coins. But in any case, you can hold it, or you can spend it. So you can use it to buy things, or you can use it to facilitate specific types of transactions, or to take out leverage. In any case, at a sufficiently highly abstracted level, mass adoption will come when cryptocurrencies facilitate holding and spending better than fiat currencies can. So in that sense, if we build these two features to be better than what fiat can, then we will have built a better version of money in a decentralized fashion. In terms of spending, crypto is already starting to prove superior user experiences in terms of payments and settlements. So Terraform Labs, we operate two different payment companies, one in Korea and one in Mongolia. So in Korea, we launched Chai about a year ago, and today it's servicing about 1.7 million active users and is facilitating about $1 billion in transaction volume run rate per year. In Mongolia, we have MimiPay, which is something that we launched about 6 months ago in consortium with a local partner. So that entity is doing about 30 to 40,000 monthly active users and is growing very quickly. So outside of our payment efforts, there is also Coinbase Commerce in the United States that is widely integrated with the likes of Shopify, WooCommerce, and then so on and so forth. I think cumulative volume for that payment service is around 300 million USD. We have WireX, Crypto.com, that facilitates the use case of creating debit cards that can be topped up in crypto. So there's millions of users that are using those different types of services. And there are pretty good reasons why users and merchants are adopting crypto-based payments over traditional fiat payments. So number one, this is quite obvious, is faster settlement times. The average settlement period that it takes a traditional payment gateway to settle is anywhere between 7 to 14 days. And this settlement period is prohibitively long for lots of different payments use cases. So for example, for a ride-hailing service, like a cab driver doesn't have the ability to wait 7 days in order for his ride fare to be settled to him, because he needs that money right away to be able to buy food for his family and fuel for the next day of operations. Same for lots of different platforms that deal with food delivery or SMBs and restaurants, because working capital issues are more significant the smaller that the entities that you deal with day-to-day basis gets, and as you start to penetrate into markets that are outside of the United States and Europe. Compared to this, Chai and MimiPay, for instance, is able to settle in 6 seconds, which is the average block time of the Terra blockchain. So the working capital benefits that you can get from like a 6-second payment service versus a 14-day payment service is obviously very large. Second value proposition is perhaps easier to grasp, which is negligible fees. Whereas traditional payment processors charge anywhere between 2.5% to 3.5% of the transaction value, for lots of different cases in cryptocurrencies, you can charge a non-linear fee that is quite trivial in most cases. So for significant types of transactions, you are able to create cost structures that are fundamentally superior to what fiat settlements or fiat payments are able to offer with these crypto payment services. We think that this trend will continue. We think that as core technologies speed up and lower the cost of transactions on blockchains, we think that the use cases for spending cryptocurrencies is going to keep getting better and better. I would say that on the holding side of things, cryptocurrencies still has a pretty big problem in the sense that for the everyday user, it is still very difficult to hold Bitcoin. And by this, I don't mean that Bitcoin is not a good investment. It can be a good or even a great investment. But the simple fact of the matter is that the vast majority of the world's population don't have the bandwidth or the resources to be able to invest with their paychecks. So for an everyday user that is planning to the very last dime on how his paycheck should be spent, if the price of Bitcoin even falls, let's say 10% by the time that he gets his paycheck and before he has the time to liquidate it, it means that he has 10% less to spend on his bills, for rent, food for his family. So the cost of volatility there for the everyday user that is not looking to do price speculation is massively, massively high. So in order for crypto to become widely adopted, you need to build features that offer principal protection in terms of the purchasing power of the user. And today, the only answer there is stablecoins. So now we have to ask ourselves, are stablecoins a good holding option for crypto? Well, yes and no. So yes, in the sense that it offers principal protection. But every time that you hold a stablecoin, instead of holding $1 in a bank account, you're suffering opportunity cost of capital on the interest payments that you can get by holding the money. So interest rates are pretty low right now, but if you hold USDC, Terra, or Tether, you get no interest. So in terms of that, like in terms of stablecoins, we have a passive income problem whereby we have to come up with ways to compensate users for their opportunity cost of capital in order to cross everyday users from into holding cryptocurrencies. So crypto needs to offer better passive income than fiat to be a better hold to the average user. And what I claim is that if we are able to create yields that are sufficiently attractive, users will have no choice but to cross over to holding crypto. And the reason for this is, if you look at compounded returns over a 10-year period for a savings account that offers 0.8%, and then a smart contract that offers 8% annualized returns. For the former, you get 108% of your capital after 10 years. So a mere 8% return for holding for 10 years. Whereas if you compound at 8% per annum, you get 216% of your original capital. And given that a user's purchasing power from a macroeconomic perspective is determined in relation to the purchasing power of the people around them, right? If all of your neighbors are doubling their capital every decade and then you're getting 8%, then in that case, it's suicidal for you to not switch over as well, because the opportunity cost that you would have to suffer on an interest rate gap that is this large would be suicidal indeed. So obviously, that's all good. Now, I guess the money-making question is, how are you able to create this type of interest rate that is both reliable and decentralized for the user? So that's essentially the money-making question. So DeFi lending has provided an interesting part of the solution, right? So we're talking about the likes of Compound, DYDX, that allow users to trade price exposure to assets in exchange for paying interest rates. So to illustrate how DeFi lending works, let me introduce two different people. So Bob, who is looking to get leverage exposure to Ether, and then Sally, who is looking to get passive income on her stablecoins. So Bob is bullish on ETH, so he's looking to take out leverage. He takes out a compound loan to lock up his Ether and get a USDC loan at 75%, as at 75% LTV. And then he uses the USDC that he just borrowed to buy more ETH. So in some case, by interacting with Compound, he's managed to increase his price exposure to Ether to, let's say, 150% of his existing capital. And if he did this recursively, like, he could actually increase his exposure to many multiples from what he had before. So on the other side of the table, we have Sally, who's looking for passive income on her USDC. She deposits USDC on Compound and loans out her coins to the many Bobs of the world that want the leverage. In return, she gets interest payments from Bob. If there are many Bobs and there are Sallys, then the interest rate is high. If there aren't that many Bobs compared to there are Sallys, then the interest rate is low. So everyone in this picture is happy. Bob gets his leverage and Sally gets yield. The problem, though, is that the deposit yield on DeFi lending markets are too volatile. Very few Bobs are willing to take out leverage for a long sustained period of time because leverage is risky and expensive. So it is only used when there's short-term catalysts for speculation. So the interest rates paid on DeFi lending protocols are powered by short-term speculation on underlying crypto prices, which happens to be highly cyclical and volatile. So this is supported by historical data from Compound, which is the graph that you see here, where we see that the borrow capacity, i.e. borrowing demand for different types of coins like BAT or Ether, is really high when ETH prices are rising quickly, i.e. there is incentive to speculate, and it's really low when prices are low or steady. So essentially, when there are reasons to believe that the price of Ether is going to go up very quickly in a short period of time, then people take out the leverage, and then they don't in other cases. So from a passive income perspective, this is a problem for Sally because she needs dependability in her savings and in her interest rates. If the deposit interest rate fluctuates wildly between 0 to 8%, erring more towards the 0% end of the spectrum, then she can't compute the opportunity cost of her capital versus what the types of returns that she can get from a savings account or an IRA product. So in order to buy into this new smart contract savings system with confidence, she needs to know that she's getting a fundamentally better deal than what she can get at Wells Fargo. So she needs predictability in terms of what interest rates that she can get from smart contract protocols. Now, we wouldn't be bringing up this problem if we didn't feel like there were features that could address, some of these issues. So we claim that, a big part of the solution comes in the form of what we call liquid staking derivatives. So for those of you that don't know what liquid staking derivatives are, let's just do a quick background on what this is. So proof of stake consensus forces a user to stake their tokens into a blockchain, which is to make them non-transferable for some period of time. So for the Terra blockchain, it's 21 days, and subject them to sashing risk to enforce honesty about block validation. And in return for that, people that choose to stake tokens get some sort of block reward, which is a part of the token inflation or transaction fees that are made from various types of transactions that are being made in the network. Liquid staking derivatives are shadow tokens that has all of the facilities of staking, but are liquid and transferable among different users. So liquid staking derivatives are essentially shadow tokens that are backed to one-to-one by staking positions, but at the same time gets the cash flows from the underlying stake position, but at the same time can also be transferred. So essentially, you can think of them as vouchers that gives the holder ownership to the underlying staking position, which, by using these derivatives as a core primitive, we can start to build the beginnings of what we consider to be very dependable and reliable sources of passive income. So to solve crypto's passive income problem, today we're announcing Anchor. So what Anchor is that it's essentially a savings account where stablecoin deposits are used to facilitate staking positions across multiple proof of stake blockchains. And the cash flows from the staking positions are used to fund passive income for depositors. Now, we believe that Anchor is an exciting opportunity to stabilize passive income sources for depositors because it taps into the block reward. And the reason why we think that the block reward must be the primary funder of passive income is because, number one, it's reliable. So Bob is flaky and short term, so he's only looking for speculation, whereas the block rewards are funded by steady and fixed schedule token inflation and transaction fees. So most blockchains have a fixed schedule by which a certain percentage of the new tokens are minted to fund network security, and it's way more steady than what you can get from tapping into speculative leverage. And number two is scale. So the block reward is and must be the greatest and most reliable source of income on the blockchain. And this is because the network security of underlying blockchains should always be greater than the value of the assets that it's securing. So in some sense, like if you are looking to create sources of passive income, similar to the way that commercial banks tap to the greatest source of wealth in fiat, which is the federal funds rates controlled by central banking institutions in the US. In order to create passive income on the blockchain, we need to be tapping into the block reward, which is the greatest source of value generation across proof of stake networks today. So Anchor Yield is also powered not just by one, but by a diversified income stream of staking rewards from multiple different POS blockchains. So from that sense, we can benefit from the diversification of those cash flows and offer low volatile interest rates that are attractive on stablecoin deposits. So looking under the hood, Anchor relies very strongly on liquid staking derivatives. From a smart contract architecture perspective, Anchor looks quite similar to Compound. There is still a Sally making her deposits and Bob looking to take out loans. So the one key difference is that Bob collateralizes his loans with liquid staking derivatives. So in some sense, these collateral positions accrue cash flows from the staking rewards that accrue to these derivatives. In the Anchor system, Bob doesn't have to pay any interest to Sally in order to maintain his loan. Staking rewards accruing to his collateral pays for Sally's interest, and then the rest is paid to him. As he doesn't have to pay any explicit interest rate, Bob is less concerned about winding down his loan, and he's able to take a much longer term perspective in terms of getting the loan. So the key difference of the Anchor system is that given that the underlying assets are cash flow bearing, the resultant system is much more capital efficient than existing crypto lending markets where the collateral tokens don't bear any cash flow. So that's one of the key differences. So we believe that Anchor has potential to be the reference interest rate across the universal blockchains. Anchor will be running across the interchain from day one. We will start out with Luna, Dot, and Atoms as the starting proof of stake assets. And we ultimately plan to integrate with all sufficiently liquid proof of stake assets over time, including Ether. As described previously, Anchor is a diversified stream of cash flows from the best sources of yield on the blockchain. So the resultant rate, right, which is the Anchor rate, has the potential to be more stable than any one of these one rates. Today, we live in interesting times where unrestrained quantitative easing is wiping out passive income opportunities across the world. In most developed countries, interest rates have fallen below 1%. And really, there's real opportunity to acquire the millions of households looking for better sources of passive income that are not correlated with central banking monetary policies. So what we're trying to create with Anchor is a stable and attractive interest rate that is decentralized. And we believe that such an interest rate has the potential to cross over millions of households looking for better savings experiences across the entire world. We see Anchor being used in lots of different applications, such as retirement IRAs, vanilla household savings, even fintech apps such as Venmo or Robinhood that are holding significant amounts of user balances, crypto exchanges, and long-term escrow such as in real estate where there happens to be money locked up for long periods of time. Starting off, in Korea specifically, Chai will be one of the first services to adopt Anchor. So Chai already has millions of users, and through the Chai card is ubiquitously accepted by every merchant in Korea. By weaving Anchor for savings and Chai for payments into a common user experience, we are able to provide better terms for holding and spending in terms of Terra stablecoins than users can get through the Korean won. In fact, through ubiquitous payments and a superior savings experience, you eliminate the reasons why a user needs to hold KRW at all. And I think by sort of closing the user's retail loop on what they need from their money in both payments and spending is the only real way to get to get mass adoption in terms of cryptocurrencies. Okay, folks, so that's a wrap. I spoke about Anchor as a means to create superior savings to get mass adoption for cryptocurrency. You can follow up with updates for Anchor at anchorprotocol.com and follow Anchor_protocol on Twitter for more recent updates. All right, thank you so much.